creating wealth, freedom, and security using real estate investing. This is Get Real Wealthy. You're watching Quentin D'Souza, and this is Get Real Wealthy. Let's go. All right, we're going to be talking about 5 mortgage traps real estate investors face. This is why it's important for you to have flexibility with your mortgages while investing in real estate. The first trap is a fixed closed mortgage with a 5-year time frame. Now, from a risk perspective, a lot of people, probably wouldn't like this. But the challenge with having a fixed closed mortgage with that 5-year time frame is that you may have got interest rates that are lower, but you're going to have problems accessing equity. So number one, that fixed closed mortgage, you're going to have a large prepayment penalty if you want to break that mortgage after a year or two. So that large prepayment penalty is going to hurt you. Don't always think of lowest rate. Lowest rate isn't what a real estate investor should be looking at. They should be looking at flexibility, and large prepayment payment penalties, not fun. The other mortgage trap is buying insurance on your mortgages. Because oftentimes when you are getting a mortgage, the bank will offer you insurance on your mortgage at a specific insurance amount rate. But what's happening here, you've got to remember, you're buying insurance on a mortgage where the mortgage amount is actually declining, and you're paying mortgage insurance at a specific rate. So you're paying insurance at a higher rate for a declining coverage over time. My suggestion to you is just get a term life insurance policy that will cover you for the same amount of the mortgage, and then you're covered off in the same way. Okay, so don't buy the mortgage insurance coverage. At least from a real estate investing perspective, not going to do that. Okay. Number 4 is trapped equity and inability to access that equity. There are different phases that you go through as a real estate investor. You go through the build phase, you go through the growth phase, and then you go through the stabilization phase. In the build phase, you need to push up your loan to values in order to buy more assets. In the growth phase, you're probably going to grow but stabilize your loan to values, bring them down a little bit. And in the stabilization phase, let's say you're going really low loan to values but higher cash flow. That's mostly where you're going to be when you're in retirement mode, let's say. So if you have a fixed closed mortgage with a 5-year time frame, you're going to have equity that's trapped in there. So you're going to have to pay higher amounts in order to untrap that equity. Instead of being able to refinance the property with the same lender, you'll probably have to get a second mortgage with a private lender at 8 to 10% versus maybe 3 to 5% in a first mortgage with the same lender that you were before. So you got to watch out for that with fixed closed term 5-year time frame mortgages. Number 5 is you need to think about your portfolio and taking on the lowest interest rate versus allowing you to grow your portfolio. Okay, so you need to think of mortgages from a portfolio perspective and how each mortgage is going to help you to be able to buy the next property, not just close on the property that's in front of you today. There's a little bonus if you think of mortgage brokers that are out there and lenders that are out there. Those ones that look at you from your goals versus just qualifying on the next property is the type of mortgage broker or lender or mortgage agent that you want to work with. Because if you tell them my goal is to buy 10 properties, and they put you in a bunch of products that don't allow you the flexibility to refinance because it pays them more, instead of trying to help you to buy the next couple properties, then you're going to have a problem. So you want to make sure that you have the flexibility. I tend to go with 1-year fixed term mortgages or with variable rate mortgages. In the current environment, it's a little challenging because interest rates are going up. But if interest rates come back down, I will still be in that position. Now, other people would rather, look at what's happened and be in a 5-year term mortgage because they feel the most comfortable with that. You got to figure out what's most comfortable for you. For me, I make sure that I have flexibility with my mortgages. I'm willing to have that because number one, I'm not going to go with fixed closed mortgages with a 5-year time frame. Number two, because of the large prepayment penalties that happen if I need to get out of it. Number three, I'm going to avoid the insurance on mortgages that are declining coverages. Number four, I want to access that trapped equity, and 5-year terms make it more expensive for me to access that. And number five, I'm thinking of building a portfolio, not what is the lowest rate. And that's something that you always want to keep in mind when you're building a real estate portfolio. So look for those brokers and lenders that'll help you to do that. If you want to talk a little bit more about investing in real estate, you can reach out to me in the description, quintindesouza.com, book a 15-minute discovery call, and we can see if there's a good fit together. Until the next episode, we'll see you later.
Make sure to check out Until Next Time, I'm Quentin D'Souza. Get out there and take action. The views and opinions expressed in this podcast are provided for information purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action.
For more information, go to getrealwealthy.com.